Hey everybody, it's Mitch Ferraro here. Thank you so much for joining us today here at F Street. Super proud of all of you for joining us. I just want to say thank you for coming and listening to me today about our private debt fund. It's always nice to know when investors are doing their due diligence and learning more about their investments. Really appreciate everyone here today. So again, today we're going to talk about the private debt fund. I'm the investor relations manager here at F Street. I work with all the investors that come into any of our funds here. And just real quick, if you have any questions during the presentation, you can use the hand raise in the chat. You can ask questions along the way. We'll answer those along the way, and then we'll also have time at the end of this to go through the questions. So the private debt fund here at F Street. So first off, the F Street, like who are we? So F Street's an alternative real estate investment firm focused on building long-term wealth, right? We are here to help you invest, build long-term wealth, generational wealth. Our owner and founder, Scott Lurie, has a saying that we're planting money trees. He loves planting money trees. Those are all the investments that we do here to grow the investments, to build generational wealth. So we're here to help you grow that generational wealth. We're an alternative investment firm. The different silos or different areas that we're in multifamily, we're in industrial. So we do new construction industrial, value add industrial, new construction multifamily, value add multifamily. And today we're going to be talking about the private debt fund, which is the real estate lending side of the business. So F Street, the private debt fund. So it's a 10% annual interest fund that pays out on a monthly basis. We paid on the last business day of every single month. Today is January 30th. All of our investors are going to be receiving their monthly interest payments tomorrow on January 31st. It's very stable returns. It's 10% annually. Again, gets paid out monthly. It's something that is very easy, very passive. You can choose between the monthly distributions, or we also have a compounding feature that we'll speak on in a little bit. And then it's a great way to supplement your life. Whether you're retired or you're not retired and have a W-2 or you're investing in other investments, it's a great way to receive that monthly interest payment, receive those payments every month to supplement your lifestyle. Very easy how it works. I love this. Very simple investment. If you made a $100,000 investment into the private debt fund, every single month on the last business day of each month, you're going to receive $833.33 on the money every month, last business day. At the end of the year, you're going to receive a 1099 INT. That's basically the tax document that you'll be receiving. And then you'll also, at the end of the 1 year hold that we have on your money, again, this is very simple, 1 year hold. We have a 90-day call return, two-way call return. So basically, we can either return those funds to you after that 1 year, give it a 90-day term to you, or you can request those funds back after 1 year, and you will we get 90 days to return those funds to you. We're typically returning those much quicker than 90 days, but we do give ourselves a 90-day period after that 1 year term. It's one of the really nice things that I like about this fund is that we're only holding the money for 1 year. After that 1 year, you basically decide if you want to continue to receive the 10% annual interest and continue to receive the monthly payments, or you can pull your money out of the fund at any point in time after that 1 year. So we have a really cool feature that we started in June of last year. We can now compound your interest into the fund. And this is a great tool to grow your money faster. So instead of receiving the monthly payments every single month, you can just have those interest payments compound onto the principal and compound onto the interest payments every single month. You can see on the graph here that there's an illustration of the $100,000 investment, 1 year to 5 years versus receiving the payments versus compounding the interest. In a 5-year span, you would earn $14,000 plus more, $14,530 more money if you compound every single month versus receiving the interest payment every single month. So this is a great feature to grow your money faster. And it's also a great way if you have a self-directed IRA or solo 401k to use a retirement account to go ahead and compound your interest every month instead of receiving it every month into your retirement account. And also, you're shielded from the 1099 INT with the SD, self-directed IRA or solo 401k. So great feature inside of the private debt fund to compound your interest. Fund benefits, I love this number. Over $5 million were paid out to investors last year. Over $5 million to all of our investors was paid out last year in interest payments. And it's a great tribute to the fund and its track record. The fund's been around for 16 years. Our owner and founder, again, Scott Lurie, has done a great job. He's never missed an interest payment. Every single year he pays out. Every single month he pays out. It's been a profitable business since day one. So you can expect that consistent cash flow. We continue to see high demand on the lending side of the business, and we'll dive into that a little bit here. And again, we have a lot of stability and liquidity. Again, just 1 year hold on that money. That's it. 1 year. After that year, you can take your money back, or you just can continue to earn the interest payments every single month. So how do we actually provide you the 10% annual return? And that is, we have a hard money lending business on the front end of the fund. So we're basically loaning money out in that fund to real estate investors that are buying properties, typically they're single family homes, at below market value. The borrowers are getting these properties at below market value. And how are they getting them at below market value? Because the properties are typically distressed. They have foundation issues, plumbing issues, electrical issues. These properties need to get fixed up so they can buy them at below market because they're going to add the value to them once they go ahead and fix them up. So we have borrowers that are flipping those homes, so they're buying them, fixing them up, and then reselling them on the open market. And we also have borrowers that are using what's called the BRRRR strategy, the buy, rehab, rent, and refinance strategy, where they're buying a property, fixing it up, getting it rented out, and then they refinance with longer term debt to be able to pay off our short-term loan to them, and then they keep that property as cash flow as a rental. So two main types of borrowers. We cap it at 65% of the after repair value. So basically, we only loan up to that amount. And then also, the borrowers have to have some skin in the game. When they purchase the property, they have to bring somewhere between 10 and 20% down to purchase the property. We have about 600 active loans out in the marketplace at any given time. It's a great way of people using hard money to flip homes or build their rental portfolio. So this is kind of the business structure that we have. One thing that you just need to understand about the Hard Money Co. is we do everything in-house. All of the people at F Street that are working at F Street are working on the hard money side to be able to basically market to get the borrowers, to underwrite the deals once the applications come in. We have our underwriters underwrite the deals to make sure that they are good deals that will loan out on them. We take in about 300 loan applications a month. We loan out to about 30 to 40 of those a month. So we're at about 10% of the amount of loans that come in, we loan out to. Then we process those loans as well, all in-house. We originate everything in-house. We do all the repair draws. So once the work's completed on a specific property through the scope of work, we do all of the repair draws. We use a really cool piece of technology called TruePics, where the borrower takes a picture of all completed work. It geolocates those pictures so that we know that that's the actual house that they're loaning out on, that they're doing the work on. And then we provide the draws for those. We do all the servicing and collections, and we also do the REO management as well. We do know we're in the lending business. At sometimes the borrowers are not able to pay their interest payments, or sometimes borrowers stop communicating with us. And because we go in first lien position on every single asset that we loan out on, we are able to foreclose on that property if we need to, and we can take that asset over. And then we have a couple of different options of either selling it on the open market, selling it to an investor within our network, or we can fix up the property ourselves if we have the resources in that market, and then sell it after we fix it up. But the big point of all of that is that we do all of this in-house, nothing third party. It's all us. So we have a great team here that manages all of that. And it's a great way to, again, for flippers and investors that are using the BRRRR strategy to invest in real estate. Now, we have the terms of what we're charging the borrowers to borrow that money short term. We are charging them 15% and 5 points to borrow that money short term. We start the first term out at 6 months. The borrowers can extend that term to 12, 15, and 18 months. If they do extend, we do charge them another 5-point origination fee to extend that term. Now, this is what allows us to pay you, the investor in the fund, the 10% annual return, because we're charging the borrowers 15% and 5 points, and then we're providing you the 10% annual return, and then we're keeping the spread of the 15% and 5 points. And that's what makes the business profitable. You want us to be profitable. You want us to keep that spread because that allows us to continue to pay you the 10% annual return. It allows you to be stable, to know that you're going to receive that 10% annual return. So this is how we actually operate the business to make sure that we can provide that return to you. On the REO side, again, we know we're in the lending business. We know it happens. This is something that for us, we make sure that if we have to take a property over, we are still trying to make money on that property. Year over year for the past now 6 years, we've been profitable in all of our foreclosures and REO management. It's actually over that time frame, it's become a net profit center for the business. The biggest thing is that we're not losing money on the REOs. We're actually making money on the real estate owned. And again, we typically foreclose on about 2 to 3% of our loan portfolio per year. And actually in 2024, we had a really great year. We were less than 1% of foreclosure on the properties that we're borrowing out on, which is so the question was, how easy or how long does it take? It's very interesting. Every state is different. It's depending on if they're a judicial or non-judicial state. Typically, a 6-month process goes through to foreclose on the actual asset. And there's a lot of different things that kind of get involved with that, whether the borrower makes a payment or we just don't hear from them. But typically, it's about a 6-month process to foreclose. Yeah, so the question was, do we expect to lower the 15% rate to the borrowers? It's always been 15% and 5 points. Since the fund has started in 2009, Scott has always kept it at 15 and 5. I will say we are at the higher end of the market for our rates, but we are also one of the easiest hard money lenders to work with. We're very quick. We underwrite in less than a day. If you have a smoking hot deal, our borrowers know they can come to us and we can get that deal to them. Once title's ready, once the transaction's ready to fund, we can fund very quickly. And we also are very easy to work with when it comes to repairs. When the repairs are needed and the money is needed to pay the contractors, we do a very good job of getting that money to those investors to pay off. So we don't foresee us dropping 15% and 5 points. Again, hard money can range in a lot of different areas from 12 and 3, 13 and 2. We're going to continue to keep it at 15 and 5. How much is the loans lost provision? So this might touch on, I'm not really clear on that question, but this might touch on what the war chest is. So there's $11.5 million on our balance sheet of owner equity. So Scott has $11.5 million on the balance sheet that he keeps there just in case the business is not profitable. So that has never happened since 2009. The business every single month has been a profitable business. But every single year, what Scott does is he takes the profits from the business, and 50% of those profits stay on the balance sheet as owner equity as a backup plan. And the other 50% he uses to go pay taxes. So every single year that continues to grow. And again, we're at about $11.5 million right now. And it's just another way that we try to diversify the risk inside the portfolio. We have $11.5 million on the balance sheet. We go in first lien position on every single asset. We manage everything in-house. Just many different ways that we try to diversify the risk inside the portfolio. And oh, do we have another question? The total loan value in 2024 was $54 million that we lent out. So again, so then the war chest here at F Street, again, this is something that will continue to happen. It will continue to grow. Again, this is Scott's money that he decides to keep in the fund as a rainy day fund to make sure that you as the investor have another layer of protection in the portfolio. So just really quick, I just want to touch on very briefly about our other opportunities right now. We do have open, as I mentioned, we're in the multifamily space and industrial space. We have our OCLV MF3 phase 2 of this part of this equity deal that we have. It's called Summit. It's phase 2. We're expecting to close on the end of March, break ground in April of 2025. We're currently raising about $6 million for this deal. You can see the targeted IRR is a 17.91%, cash on cash 8.75, equity multiplier of 1.87. Again, this is 58 units going up in Oak Creek, Wisconsin, that we'll be developing. We've already developed on this site. We have one apartment complex already there. We're building another one right now, and then we're going to be closing on this development at the end of March to break ground in April of 2025. This is an opportunity. If you go to fstreet.com, you can see more about this opportunity. And then we are also continually doing industrial deals. So if you're an investor with us already, you've probably seen these deals come through the pipeline and they close quickly. We raise the capital very quickly on these industrial deals. We're very bullish on industrial acquisitions right now. As you've seen, we've done two probably in the past 2 months here. One in Granger, Indiana, the other one in Maysville, Kentucky. Both of those we did capital raises on, about $3 million for each one, and we raised that money in about 24 hours for each of those deals. This as well, if you go to fstreet.com, you can see Maysville is still up there. You can see what that deal looks like, and we do have more industrial deals in the pipeline that we're putting under contract right now, and you will see those. If you're an investor that has not been investing with us, and this might be your first time, or maybe you're seeing the recording, I highly suggest going to fstreet.com and signing up for our investor portal. There's no cost or anything like that, but you will then start having access to these deals, and these deals will be sent to you to possibly invest with us in the future. So the question was, will F Street come out with an industrial fund? That is something that I would talk with Scott about. But honestly, what we do for all of our equity deals is we build what are called special purpose entities, SPEs, for each deal that we acquire. So what we do is we basically create an LLC for that specific deal. And then if you're an investor that wants to invest in that deal, you then become a limited partner. You hold an equity position in that LLC, in that special purpose entity. So that's how we do it now, building those special purpose entities for every single acquisition or development that we do. And just so you know too, there's no crossing or commingling of any of the SPEs. So there's nothing from the private debt fund goes into an equity deal or vice versa. When you invest with us, you're investing into a specific deal or the private debt fund. I just want to go back here real quick. So this is what the investor portal looks like. We've spent a lot of time, money, and resources to make our portal very accessible, very easy to use. It's really, really nice. And if you're an investor on our call, you probably know how easy it is to get invested with us. You literally click on our offerings tab. You'll see one of the deals come up. You click invest now, you sign some paperwork, and then you let us know if you're going to wire the funds or if we're going to ACH one-time pull the funds. Super simple, very easy to sign up for the portal. And again, I'm the investor relations manager. If you have any questions on how to sign up, about the deals, I'm your main point of contact. You can contact me. You can contact me at mitch@fstreet.com. You can just shoot me an email. I can get back to you. I'm very available. I respond very, very quickly, or at least try to. And I can help you with anything that you need. If I can't get you the answer, I know I have the resources and the team members around me to make sure that we can get you what you want. And a lot of times too, if you're interested in the equity side of our business, I typically bring in one of our development associates to talk about those deals with you because they are much more knowledgeable about timelines, distributions, and what the deals look like. So again, fstreet.com, sign up, at least get signed up. If you are, one thing I should mention, every single investor that comes into any of our funds here, they must be an accredited investor. An accredited investor, there's just some financial criteria that the SEC has for guidelines. If you're you either can be an accredited investor through your income or through your net worth. If it's through your net worth, you have to have $1 million or more, not including your primary residence. If it's through your income, you have to make over $200,000 a year or more if you file your taxes solely. If you file your taxes jointly with the spouse, you have to make over $300,000 a year or more, and you have to have done that for the past 2 years. So every investor must be accredited, and we go through that process with you as well. That takes about 5 minutes to do. Very simple. So again, go to fstreet.com, get signed up, or if you're an investor with us already, continue to be on the lookout for a lot of our deals, or continue to invest in the private debt fund. You can invest in the private debt fund as much as you want. You make an investment today, and then after 2 months, you really like it. You see the interest payments coming in every month, and you want to invest more. You can invest more again. And what we do is pretty simple. You have a 1-year hold on your money, like I had mentioned before. You have that 1-year hold on the investment that you made today. And in 2 months, if you make an investment again, we're just going to create a new 1-year hold for that new money. So you'd still have a 1-year maturity date for today's investment. And then you would just have a 1-year maturity date for the next investment that's 2 months down the road. So you have different maturity dates for your different investment timelines. Yeah. So the question was, when does it start, when does my money start making money? The day that we receive your payment is the day you start earning interest, and you will receive your first interest payment in that same month. So for example, we're going to be coming up on February 1st here. Let's say you made an investment into the private debt fund on February 10th. Once we receive that money on February 10th, you start earning interest that day, and you will receive your first interest payment on February 28th, because I know that's a Friday already. You'll receive your interest payment on February 28th. You'll receive it for the prorated amount of days that you've been in the fund from February 10th to the 28th. And then you'd receive your first full month's interest payment in March, because that's the first full month that you've been in the fund. But you would receive an interest payment in February for the prorated amount of days. Yeah. So another question was, if I request my funds back, do I still earn money? And when you request those funds back after the 1-year hold, you earn interest up until the day you receive your funds back. So the day that we set the ACH pay to go back to you, we will include all of the interest for that month, and you get your money back. Yeah, yeah. So great question. So the question was, what do we foresee with the increase in costs? What is that? How is that in materials and supplies? How is that going to affect the fund in the future? So I'm also a licensed real estate agent here in Wisconsin. I have my pulse. I have a pulse on the market. I watch a lot what's going on in the market. One thing that you are still seeing across the country right now is there is a big demand for housing and not a lot of supply, and that's medium price point homes. Like it is so hard right now to find a medium price point home almost in any market. They're still flying off the market once they're on the market. If they're priced correctly and if they're decent homes, they are selling very, very quickly. What's nice about our fund is a large majority of our borrowers are putting that type of product on the market, whether they're buying a house and fixing up and flipping it, or if they're even buying a house, fixing it up, and then getting it rented out, they're putting this median price point product on the market that's in very, very high demand. So I still foresee with rising costs that demand is going to be there because we just can't build cost-effective homes fast enough for the amount of demand that there is. Yep. So great question. Is there a minimal investment once you make the initial? So the initial minimum is 50,000. After that, you can invest in $5,000. You just have to be, it has to be $5,000 or more. So once you make that initial investment, if you want to invest more money, it just has to be $5,000 or more. All right, so what percentage of investors reinvest immediately? So I would say it's a very good question, and I'm just trying to think off the top of my head. I would say somewhere between 10 and 15% of investors, once they invest once, they invest right away. I would say about 50% of investors at some point in time will invest more into the fund. So right away, about 10, 15%, but as they're in the fund, I would say more than half are investing more money into the private debt fund. So OCLV MF3 is an LLC, and you become a limited partner in that LLC. So the way that the structure works is there's a general partner, which is F Street and our principals, and then every investor that is in the deal that puts money into the deal becomes a limited partner in that deal. And what's nice about being a limited partner in those deals is that you as the investor get paid first and get paid all of your interest and get paid all of the principal that you invested back before the GPs start making any money on the deal. So F Street does not start making any money on the deal until all of the investors, all the limited partners are paid all the interest that they're owed and their initial investment is paid back to them. And then we go into a split of cash flow after that. So the question is there a large immigrant population for the apartments? I do not have the answer to that question. I'm not sure what the population looks like for that. So I could. Yeah. So if who's asking that question, if you want to email me at mitch@fstreet.com, I can actually put you in contact with the property management company, and we can get that answered for you. What was it? Yeah, so someone wanted clarification if you could compound the interest in the private debt fund. The answer is absolutely yes. We just started that feature in June of last year. One thing that I do want to mention about the compounding feature, if you compound inside the private debt fund and you're not using a self-directed IRA or solo 401k, you still will receive a 1099 INT at the end of the year. The only way to shield yourself from the interest the tax that you owe on the interest is to use a self-directed IRA or solo 401k. If you have a self-directed IRA or solo 401k, awesome. You can absolutely use that to invest in any of our deals and the private debt fund. If you don't have one and you want to get one, we also have trusted partners. One of our main partners is Equity Trust, also known once as Midland IRA. We can put you in contact with them to get one set up so you can start investing through a self-directed IRA. All right. Any other questions? We're about 30 minutes here. Again, I just want to say thank you to everyone that joined today. You guys had awesome questions. I love the questions. Again, you don't understand. I love it that y'all are doing your due diligence and learning more about the private debt fund, learning more about these investments. Knowledge is power, right? So kudos to all of you that are on this call today or watch this recording. We really, really appreciate you coming on today. So great question. So the question was, if you started out, let's say compounding, can you switch over to receiving the payments every month? Absolutely. There's actually a pretty cool feature in our investor portal. It literally says switch to compounding, and you can switch back and forth right there. All right, awesome. Well, again, I'll just wait maybe about another 30 seconds here for any other questions to come in. Again, my name is Mitch Ferraro. I'm the Investor Relations Manager here. Again, I'm your point of contact here at F Street for anything investment related. If you want to invest or want to learn more or have other questions that you want to take offline, please email me, Mitch, MITCH, at fstreet.com. Again, I'm very available. I love talking about this stuff. It's a lot of fun. And again, it's about our future and growing our wealth. So again, thank you so much for your time today.
Few more questions.
Sorry, what was it again? Yeah, so if we can't pay interest or principal, the number one course is the war chest. We use that $11.5 million to put if we didn't have a profitable month, we would use the war chest to put the business back in the black so we can continue to pay out the investors their 10% annual interest. I'll also clarify with that we're backstopped by, again, we have about 600 active loans out in the marketplace at any given time. We are in first lien position on all of those assets. That means we can take those assets over if we were to have to, if the borrower was defaulting on the loan. Also, too, we've never missed an interest payment. The fund's been around since 2009. Every single month since 2009, we've made that 10% annual interest payment. We paid it on the last business day of each month. It's a great track record, great passive investment. Oh, this is all right. This is a really good question. So someone asked if are we seeing challenges with borrowers that want to refinance out of our loan into longer term debt with the higher interest rates? This is why it's so important when we underwrite these deals that we underwrite them correctly. We have to make sure that we're taking into account these higher interest rates. If you are an investor or borrower that's borrowing money from us and you're going to refinance out of a loan, you better know what those interest rates are going to be in the future, because that's absolutely going to affect your cash flow every month. I will be quite honest. I built my whole entire rental portfolio through the BRRRR strategy. I don't use the BRRRR strategy right now because interest rates are high. We still have borrowers that do it, and they can do it very effectively, but you have to make sure that you're buying that property correctly at the right price, because if you don't, it's going to directly negatively affect your cash flow every single month. But yes, it's high interest rates right now. If you can get a good deal and you can refinance at these high interest rates and still make money, you got yourself a really good deal. Yep, absolutely. So the question was, we've always paid interest payments. Do we pay the principal back right away like we say we're going to do? And yes, every single time that we've been asked to pay back the principal, we have paid it back, and we pay it back as quickly as we can. I know we give ourselves a 90-day period, but to be quite honest, if an investor is requesting like $500,000 or less, we're typically getting that back to them within about 2 to 3 business days. And I believe we even have investors on the call that can vouch for that, that we give them their principal back as quickly as we can. All right, that's all the questions. I love it. If you guys have any other questions, let me know. I'll stay on just for a couple more minutes here. Again, thank you so much for your time today. I really appreciate it. No matter where you are, we're glad you're here with us this afternoon, learning more about the private debt fund. Again, Mitch Ferraro, Investor Relations here at F Street. You can reach me at mitch@fstreet.com. Stay on for about another minute if there's any other questions. If not, everyone have a great day, wonderful day. We're in Wisconsin. It's actually like 50 degrees here today, which is great. Feels like summer. I got my short sleeves on. So I hope everyone just has an awesome day. The question was, have we ever had to dip into war chest to make a payment, an interest payment for the month? We've never had to use the war chest. Never.